Today's video is going to be all about investments, specifically how to build a portfolio as you're nearing retirement that will provide you with liquidity, growth, low investment costs, and most importantly, peace of mind. Quick disclaimer, this video is for educational purposes only. It's not personalized financial advice. Your situation is personalized to you and should be handled by someone who intimately understands your situation. Each part of your investment portfolio can be looked at as a part of a team working together to accomplish the same end goal. Now, your offense is competing against inflation, and you don't want to win by an extra point. In this game, every point matters, and your long-term growth engine is going to be your stock or equity allocation. This is what helps your portfolio grow and keep up with inflation over time. At JRS, I follow a low-cost indexing and liability matching approach. Let me explain what that means. Most people don't realize that nearly 9 out of 10 actively managed U.S. large-cap funds underperform the S&P 500 over a 15-year period. Even though they're charging fees between 0.5% to 1.5%, why pay extra to get less? Let's look at real numbers. If you invested $10,000 back on January 1st, 2016 and held it through September 2025, a low-cost index ETF with a 0.04% expense ratio grew to about $49,000. Two randomly selected, actively managed large-cap growth funds both grew to under $42,000. So over a $7,000 difference. All the while, you're paying Wall Street and big investment firms a substantial recurring fee. So that's why I believe in the low-cost index approach. Overall, I'm talking about your equity exposure as the offense of your portfolio. So now imagine that on a $100,000 portfolio over 10 years with identical 7% returns, the low-cost fund ends up at about $196,000. The fund with, again, identical returns with a 1% fee ends up at $179,000. That's a $17,000 difference gone, not because of bad performance, but because of underlying investment costs. Your higher cost, actively managed mutual funds need to beat not only its benchmark, which is statistically hard to do over a long period, it also needs to overcome the negative compounding effect of high fees. That's why I like low-cost index investing for the offense in your portfolio. It lets you capture the market, avoid performance chasing, and still allow for smart tax moves like asset location and tax loss harvesting. Asset location is the ability to keep different parts of your portfolio in different account types. For example, your Roth IRA grows tax-free. We want to optimize this portfolio for growth. An example of tax loss harvesting is swapping between similar index funds when markets dip to lock in paper losses for tax purposes without changing the makeup of your portfolio. There's confusion when people hear active management versus passive management. Active management in the sense of actively managing your plan with strategic rebalancing, tax loss harvesting, asset location strategies, etc., are all ways to potentially add significant value to your plan. Now, the investment vehicle you use for the equity or stock allocation can be either actively managed, where a person or a team is making buy and sell calls on stocks trying to beat the market or an index, or a passive investment is a vehicle such as an ETF or a mutual fund that attempts to duplicate a given index. So it's not basing its buys and sells on its own research. It's basing it based on the makeup of the indexes. So think the S&P 500, for example. So active planning, yes. Active trading, from the research I've done over a long time period, you most likely end up paying much more in fees for performance that fails to beat its benchmark. Think of this as the team's uniform and equipment. It matters, yes, but you can win the game either way. My personal preference from the research I've done has me biased towards passive, low-cost index investing. But again, you can still win with active management vehicles. So in summary, the growth part or equity part of your portfolio is your growth engine. This is the offensive side of your portfolio, taking on inflation over the long run. The key to putting a plan together that provides peace of mind is having a portion of your portfolio built for long-term growth, where big drops in the market volatility, etc., does not keep you up at night, because hey, this is part of my portfolio invested for the long term. We don't need to sell these investments in the short term while they're down, meaning they can sustain the ebbs and flows of the stock market. Adopting this sort of plan with this sort of mindset can help you go out and enjoy your life. There are too many people who retire or get close to retirement, and they hang on every bit of white noise they hear about what the markets are doing or what's happening with this company or that company. This is why I always say knowledge is freedom and planning is power. Going back to the first episode of the JRS Retirement Empowerment Series, you might be wired to worry about the short term because you lived through 2008 or other past market crashes. And it's scary, I do not blame you, but the power of planning can help you to avoid this unnecessary time waster. I've seen it work magic before, and it can happen to you. Now, the other part of your portfolio is the safety net, bonds, fixed income, and alternatives. This is the defense of your team. We discussed the offensive portion. Now let's take a look at what the defensive team is, the safety within your portfolio. When I say safety, I'm referring to any investment that is not subject to stock market risk. Now that doesn't mean that there aren't other risks out there, but if the stock market swings up 10% or down 10% tomorrow, these investments do not mirror that. This safety can consist of bonds, CDs, treasuries, alternative investments. Maybe I can go further into that in a different episode. There's a lot of variety under the alternative umbrella. But now this is going to differ significantly from someone reaching retirement versus someone who is a ways from retirement. Now I mentioned earlier liability matching. What that means is aligning cash flow or the maturity dates of your fixed income investments with your income needs. I will dive much deeper into that subject during next week's video on retirement income planning. Now, the amount of safety you should have, whether you're someone nearing retirement or not, is going to be dependent on your specific situation, your risk tolerance, your investment horizon. That is something that you should work with a financial professional to get to. But in summary, this is the portion, the defensive side of your portfolio. It is not likely going to grow as much as the offensive growth part, but it's going to provide you with stability both in retirement for creating income and getting to retirement. If you have a portfolio 100% invested in stocks and the stock market goes down 40%, your portfolio goes down 40%, you panic, you sell out of stocks. That is the catastrophic situation we want to avoid. Having the right mix of both safety and growth is the key to having that peace of mind to getting to retirement, and then more importantly, having safety away from the stock market for your income needs to get you through retirement. And last, I'm going to talk about the short-term bucket or the emergency savings. We'll stick with the football team. This is like the special teams. You need an emergency savings bucket, just like you need a kicker. The amount, again, is going to depend on your specific situation, but a good starting place is 3 to 6 months worth of essential living expenses. Let's say you're dinks, dual income, no kids, probably recommend a 3-month minimum. Let's say you're a single income household, you have mortgage, you have kids, dependents, etc. Probably recommend closer to 6 months minimum of living expenses. You can find your monthly living expenses by taking your housing, food, utilities, transportation, and minimum debt payment costs into consideration. Might be some other spending worth adding on to that depending on your situation. Now, this would be the special teams of your football team. It's not going to be super exciting, but without it in place to provide liquidity and security, the whole season can get blown. The funds should sit in either a money market fund or a high yield savings or potentially a mix of short-term CDs and treasuries, but think little to zero risk on these funds. However, you should earn the best interest rate you can. I often find people who are unfortunately making banks or credit unions money by accepting a sub 1% interest rate. Even when interest rates rose, this institution kept your interest yields at sub 1%. I want you to make that interest, not the banks. You can either negotiate with your bank to get closer to the going market rate of high yield savings accounts, or it might be worth shifting those funds into something yielding higher, either a different high yield savings, a money market fund, short-term treasuries, etc. So when you put this all together, your stocks are your offense, drive long-term growth. Your bonds and alternatives are your defense, diversifying your portfolio away from stock market risk, and use strategically to create income in retirement. Your short-term cash or emergency savings funds gives you liquidity and peace of mind. That's the foundation of a retirement-ready portfolio. Thank you for listening to part 2 of the JRS Retirement Empowerment Series. As always, money is a tool, knowledge is freedom, and planning is power. I will see you next week. Please hit the subscribe button, and I hope you have a great rest of your day.